Hello and welcome to the Business Standard Morning Show. I'm Kanishka Gupta and let's have a look at the stories for the day.
This is GE Vernova, helping generate and move the energy that will change the world. Welcome to a new era of energy.
For thousands of Twitter employees, the realization has finally sunk in. The company will never be the same again. Over 3,500 workers have been sacked and hundreds of others have made the tough choice of quitting the social media organization. Within a few days, the firm has lost a major chunk of its workforce. Well, it looks like the chaos introduced by Elon Musk is finally taking a toll on the company. Our first report breaks down the happenings since Musk entered the Twitter headquarters.
Told to make a choice between an extremely hardcore way of work or resigning with 3 months of severance pay, hundreds of Twitter employees were said to have opted for the latter last week. Twitter's new boss, Elon Musk, had set 17th November, 5 p.m. US Standard Time as the deadline. According to an estimate, the number of resignations up to early Friday may have topped 1,000. After having recently bought Twitter for $44 billion, Musk's reaction to the reported mass resignations can be best summed up in 3 letters: LOL. In a tweet, Musk said that he was not super worried about the development. Alex Heath, editor of The Verge, wrote on Twitter that several members of Twitter's command center organization had also resigned, along with all the key infrastructure teams. Heath said that he had received information that Musk's transition team had identified this command center as the linchpin that kept Twitter operating day to day. Heath has been tracking the developments at Twitter for some time now. Zoe Schiffer, managing editor at Platformer, tweeted that the designers who were leading Elon Musk's Blue Verified project had also resigned. Business Standard could not independently verify these details at the time of production. Slack, the internal communication platform used by Twitter, was flooded with salute emojis sent by employees who had resigned. They did not want to be part of Twitter 2.0. On the 4th of November, Twitter announced it was laying off 3,700 employees, including many in India, which amounted to half of the company's workforce then. After that, Twitter was left with less than 3,000 employees. If 1,000 more actually resigned last week, then 1/3 of the team has already left. Musk had talked about Twitter 2.0 in his memo to employees soon after he took over. He said that to build a breakthrough Twitter 2.0 and succeed in an increasingly competitive world, they would need to be extremely hardcore. I am not pressing the yes button. My watch ends with Twitter 1.0. I do not wish to be part of Twitter 2.0, posted one employee in Twitter's Slack, according to reports. Bloomberg reported on Friday that so many employees had decided to take the severance option that it had created a cloud of confusion over which people should still have access to company property. Twitter also closed its offices until Monday. According to one report, Musk tried to convince employees to stay in the final hours before his deadline. Meetings were held to pitch the social network's future to key staff, but these efforts proved insufficient. And in a sign of mounting troubles for Musk, a group of US senators has asked the country's antitrust regulator to scrutinize Twitter. They said that Musk had undermined the integrity and safety of the platform. Clearly, Musk's management style and the speed at which he has tried to shake things up at Twitter have caused chaos.
Elon Musk's takeover of Twitter has become a case study, I think. It's going to be famous for years as how not to do a takeover. When you take over a company, the most important thing is to go into the company, be humble, and try to learn what is the logic of this business. Just because you have been a user of a product doesn't make you an expert on how that business is run. It does not make you an expert on what are the competencies needed in that business, what are the challenges in that business.
Musk also seems to be playing into the stereotype of the impatient entrepreneur. With his need for speed, Musk took over as the head of Twitter on the 27th of October and fired key executives, including CEO Parag Agrawal, CFO Ned Siegel, and Twitter's head of legal policy Vijaya Gadde. On the 31st of October, Musk announced that he would be the company's CEO. On the 1st of November, Musk floated the idea of a $8 per month Twitter Blue subscription, which would include the verification blue tick as well. 3 days later, massive layoffs were reported at Twitter, including in India. Musk said that he had no choice. On the 5th of November, Twitter rolled out the $8 Twitter Blue for iOS users. On the 11th of November, Twitter Blue for iOS vanished. The service reportedly ran into issues as soon as it was rolled out, as people used the feature to impersonate famous individuals and companies, including George Bush, Nintendo, and Elon Musk himself. Next day, nearly 4,400 contract employees were also terminated from Twitter. Then came Musk's email about Twitter 2.0, which would require an extremely hardcore work culture and the resulting resignations.
You want to make sure if you bought something that it keeps running at an even keel for the few months before which you figure out what needs to be fixed, what needs to be changed, how do we improve this company. But before you do that, if you go in like a cowboy and you create all this drama and everybody's leaving, then of course what you have done is you've taken a very valuable asset that you bought and paid more than the market value for it and destroyed it.
While Musk's management style has proved disruptive, this doesn't necessarily mean that there is no path towards revival.
Hidden underneath this chaos is the emergence of perhaps an absolutely new idea. Twitter going to pivot to being not just a truth platform or a communication platform, but also a transfer of resources platform. That is a space that all of us must watch.
With 237 million daily active users, Twitter is not the world's biggest social network. Facebook and Instagram boast of global daily active users just short of 2 billion each. But it plays an outsized role across the globe. It's where heads of government make announcements, activists mobilize, and corporate bigwigs get closer to their customers. Any possible disruption in its services could mean that the chaos visible within Twitter could leak out into the wider world.
A venture firm in the US has launched a tailor-made program for those who are being laid off by tech companies like Meta and Twitter. The firm will give $100,000 to every startup idea. Several reports suggest that more startups have been founded by techies than MBA graduates, while another report revealed that there has been a 3.4% dip in applications for management studies across 57 countries, including India. So is the lure of management degrees waning?
A survey of 264 business schools spread across 57 countries has found a 3.4% dip in the number of people applying for an admission in MBA degree courses in the ongoing academic year. The Graduate Management Admission Council, or GMAC survey, may indicate how the post-pandemic market for management education is shaping up. The number of applications had increased 2.4% year-on-year in 2020 when the pandemic had started. And next year, when the pandemic was in full swing, these schools across the world saw a 0.4% rise. The weighted sample of the institutions shows that applications to MBA programs were down 6.5% after growing 3.8% last year. Among the MBA courses that were surveyed, about 60% saw a decline in applications. 37% saw a jump in admissions, while just 3% didn't see any change. The COVID-19 pandemic is likely to have played a key role. Shalini S. Sharma, Assistant Secretary General at the PhD Chamber of Commerce and Industry, explains.
You must remember that ultimately COVID had a very deep psychological impact on everybody's psyche, where people lost jobs, they saw a lot of suffering, they were sitting at home, there were salary cuts and all of that. Now, emerging from such a scenario, um, you think from a perspective of somebody who's now planning to leave the job, go for higher studies for another 2 years, and then come again back to the job market. People are maybe hesitant about making those decisions. Now the focus is more on retention of jobs. So yes, the regular MBA program admissions would be seeing a dip, whereas on the other hand, executive MBAs are doing pretty well, and people are choosing to take that route more.
While job retention and market instability do seem to be crucial for job seekers and prospective MBA applicants, the study also showed a growing interest among Indian aspirants to study abroad, and international applications observed a rebound. Globally, the trend had different impacts in different regions. The report revealed that the majority of US programs reported an increase in international applications, especially full-time 2-year MBA programs at 80% and STEM-designated programs at 61%. Similarly, in Europe, most MBA programs either saw stability or more applications from international candidates this year. In India, MBA programs had experienced a boom in 2021, with 69% reporting a growth in total application numbers compared to the previous year. China, too, saw a similar pandemic boom. But now, in 2022, coming off that hot year, 56% of programs have reported total application volume declines.
A lot of Indian students are opting to go abroad for higher studies. So in the US, admissions from overseas candidates are going up, but those from their own students are coming down. So that trend is also important. So in India, you may see a decline in numbers domestically, but the numbers going abroad is on the higher side.
In the rapid growth of digitization across industrial sectors, management courses have also pushed for interdisciplinarity, incorporating tech and policy-related pedagogical components. There was an increase in specialized programs in the US, such as Master of Supply Chain Management at 93%, Master in Marketing at 76%, and Master of Data Analytics at 61%. Does this show a growing need amongst management schools and programs to evolve away from traditional MBAs? Sharma believes the adaptation to the changing market scenario is also the reason for a dip in regular full-time MBA courses.
But remember, a very vast segment of MBA is the executive MBA. And we see that almost every institution which is running a regular MBA program is now offering, tens of other executive programs, which are many a times tailor-made according to the requirements of large corporates and companies. And there are shorter degree programs as well. I have seen that instead of going for a 2-year MBA degree, many students are opting to go for 1-year certificate programs. So that's another reason why you might be observing a dip in the regular MBA admissions.
The decline in B-School applications might be part of a rolling pattern, but the underlying causes do indicate larger changes afoot. While management degrees and B-Schools do hold on to their relevance, for now, all signs indicate an urgent need for both the institutions as well as the applicants to adapt and evolve.
Moving on to financial markets, frontline BSE Sensex and Nifty indices came within a striking distance of hitting fresh lifetime highs last week, but fell short owing to selling pressure at higher levels. With no triggers on the domestic front, will markets enter a long drawn consolidation phase? Will our next report delves into the market mood?
In less than a month, benchmark indices have surged over 4% on the back of solid economic recovery and hopes of moderation in inflation. Since Muhurat trading on October 24, the frontline Sensex index has leaped nearly 2,500 points, while the Nifty 50 has jumped 768 points, claiming fresh one-year high. While tepid global cues are stopping market bulls from logging fresh lifetime highs, analysts remain unperturbed with the recent slowdown in the momentum.
Well, whenever the markets have gone near the all-time high, historically speaking, there is a period of consolidation. So this time also we are witnessing the same. And not to forget, right from the Muhurat trading till the beginning of this week, we have come a long way. So I think it is only prudent to expect a little bit of consolidation profit booking so that we make a base and then possibly cross over to the, we go towards all-time high and cross over that. That will be sustainable also from a long-term point of view. So you can expect a little bit of longish period of consolidation. And the longer we stay over here, the better it is. I mean, the longer we consolidate, the better it is.
Shah of Geojit Financial Services says the near-term market trajectory will be largely driven by global headwinds.
Also, the Q2 is done and dusted. I think crude oil prices getting lower, rupee gaining a little bit of strength. We have credit policy in December. So what is the view over there? Possibly, markets will be looking forward for all these triggers. And of course, on the international front, there should be, no negative news flows as far as the geopolitical situation.
Technically too, record open interest at Nifty's 18,500 call has been one of the key reasons for the market correction.
Indian benchmark indices are currently struggling to hit new all-time highs. For Sensex, the all-time high is at 62,240 and for Nifty, it is at 18,600. One of the basic reasons why indices are unable is the option data. For Nifty, 18,500 has become a point wherein one could definitely see the highest number of call writing happening. In terms of Sensex, 62,000 has become a trouble, but the selling pressure isn't letting bulls to take the index higher. Once 62,000 is crossed with the support of 61,000, the index is going to head in the direction of 63,500. For Nifty, once 18,500 is taken out, it is definitely heading towards 19,000 level where the next open interest is seen.
Against this backdrop, analysts suggest investors may gradually buy the dips from a long-time perspective.
Given the support level of 18,000 on Nifty, which we expect the index to hold on in this current profit booking scenario, we suggest that investors adopt a buy on dip strategy on markets.
Meanwhile, with not much lined up on Indian macroeconomic front, investors will look for cues from the global markets this week. 3 key FOMC members are scheduled to speak on Tuesday night, while the monthly FNO expiry back home on Thursday could keep the markets volatile. Among individual stocks, shares of Easy Trip Planners and Maharashtra Seamless will be in focus this week as these stocks turn ex-bonus on November 22 in 3:1 and 1:1 ratio respectively. Last week, the S&P BSE Sensex ended with a loss of 132 points at 61,663 after touching a high of 62,053 during the week. The Nifty 52 settled 42 points lower at 18,308.
The chorus to regulate cryptocurrency has grown louder since the collapse of FTX. A bill to regulate it is likely to be tabled in Parliament soon. The government has also weighed the option of appointing its capital markets regulator to oversee cryptocurrencies. Meanwhile, the investors of FTX have little hope left from the ongoing liquidation process as the exchange's entire valuation has now been wiped out. So, who are the biggest losers?
Future Exchange, or FTX, as it is better known, was one of the world's largest crypto exchanges till a few days ago. It has collapsed now and is undergoing liquidation process. 30-year-old Sam Bankman-Fried, the avid gamer who established the exchange 3 years ago and later drove it to the ground, is apparently the biggest loser apart from the millions of investors. The king of crypto lost over $14 billion in a span of few days. Newly appointed FTX CEO John Ray III, who is now overseeing the liquidation process, has slammed the concentration of power in the hands of a very small group of inexperienced, unsophisticated, and potentially compromised individuals. Apart from the direct investors, several other exchanges had also kept their holdings in the form of FTX's tokens or FTT. Their money is also in danger following the fall of the exchange. Before the crash, FTX was valued at $32 billion. That money has now gone up in smoke. Out of all the investors, at least 2 major shareholders have decided to mark their investments down to zero. According to Forbes, these are Sequoia and Paradigm. It currently holds a 1.1% stake in FTX. In early 2022, the value of Sequoia's investment peaked at $350 million. If the money is not recovered, it will become the largest loss maker among the investors of FTX. Singapore-based investment company Temasek also owns a 1% stake in FTX. At the peak of its valuation in early 2022, its stake stood at $320 million. It had originally invested around $205 million in the firm. Another investment firm, Paradigm, also owns around 1% stake in the exchange. It originally invested around $215 million, and in early 2022, the value of its stake stood at $315 million. Interestingly, Alameda Research, which Sam Bankman-Fried also owned, had invested $20 million in Paradigm. The plan manages retirement funds of around 3.3 lakh teachers in Canada. It had invested around $95 million in FTX. At the peak of its valuation, the stake was valued at $125 million. Its stake stands at 0.4%. Apart from these major investors, Tiger Global Management and SoftBank had also invested in the exchange in a Series C round in January 2022. However, their stake is unknown. Also, some individual investors stand to lose big. NFL legend Tom Brady and model Gisele Bündchen owned 0.15% and 0.09% in FTX as of June 2021. It is estimated that before the crash, the value of their investment must have been around $45 million and $25 million, respectively.
The nation's trusted bank, SBI, the banker to every Indian.
As if the ongoing troubles were not enough, FTX exchange fell prey to hacking last week. The hacker is now one of the biggest holders of Ether tokens. That is all for today. For more news, views and analysis, please log on to business-standard.com. If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.